Buy low, sell high. Sounds almost, well, ridiculously simple, doesn't it?
It really does.
If it truly were that straightforward, we'd all be millionaires by now.
Exactly.
Yet this whole high-stakes world of trading, it just remains stubbornly out of reach for most people.
And you're absolutely right to question that apparent simplicity. Today, we're going to dive deep into a really fascinating collection of sources. They pull back the curtain on just how challenging this world truly is.
Right.
Forget the idea of it being a simple 50-50 coin toss. The statistics our research uncovered, well, they're nothing short of shocking.
So our mission today is pretty clear then. We're going to unpack why the vast majority of people fail in trading, and maybe more importantly, what that tiny successful percentage does fundamentally differently.
Yes. What's their edge?
It's a journey into strategy, sure, but also hard numbers and most crucially, I think, into the human mind itself. Okay, let's unpack this.
Let's do it.
Okay, let's cut right to the chase with some truly eye-opening data. A really big 10-year study by Prudential Financial revealed a staggering truth.
Yeah, I remember reading about that one.
93% of traders abandon their efforts within just 5 years. 93%.
Huge.
And of those who actually stick around beyond that 5-year mark, only a tiny 5% consistently manage to turn a profit.
Only 5%.
When you think about that, it genuinely makes trading, statistically speaking, maybe the most dangerous job in the world.
It absolutely could be argued that way. Our sources really highlight that this isn't some level playing field. It's almost meticulously designed to be what some people call a big trap.
A trap? How so?
Well, the mechanics, the psychology, it all plays into it.
Yeah.
That the profound insight here is that the successful 5% aren't just lucky. They're not just flipping coins better.
Right.
They exhibit a distinct pattern of behavior.
Right.
And they leverage specific, let's call them secrets, to harness principles like compound interest in ways the struggling majority just don't.
And when you zoom out a bit, this reminds me of Robert Kiyosaki's 4 categories of jobs, the ESB.
Cash flow quadrant, yeah. Employee, self-employed, business owner, investor.
So where do most aspiring traders, especially the beginners, typically start their journey? And what does that mean for their potential success?
Well, most, almost invariably, begin firmly in that S quadrant, self-employed.
Okay.
They're drawn to trading because they want that full control,
Right.
And they often believe they can manage risk just by being directly hands-on, making every single decision.
Makes sense on the surface.
It does, but that's precisely where the successful 5% diverge. They don't operate by trading their time directly for money, like the self-employed typically do.
How do they operate then?
Instead, they think and act more like investors, the I quadrant, or business owners, the B, meaning their money, or perhaps more accurately, a finely tuned system, is working for them.
Ah, so it's about leverage, but not just financial leverage. System leverage.
Exactly. And for anyone listening who wants to shift that mindset, the book The Compound Effect by Darren Hardy offers some really powerful insights. It's all about how those small, consistent actions create exponential results over time. That's a core tenet here.
Okay, so if trading isn't just gut feeling or, pure instinct, what's the actual blueprint for success? It clearly has to start with strategy.
Absolutely. Strategy is foundational.
I like to think of trading almost like a form of war. Napoleon Bonaparte, the quintessential military strategist,
Yeah.
he believed a strategy was fundamentally a plan to neutralize your enemy. In trading, your capital, your account, that's your army. And the market's often unpredictable movements. That's your formidable opponent.
That's a truly powerful lens to view it through. It emphasizes the need for a plan against an unpredictable force.
Yeah.
And George Soros, the legendary investor, he distilled this down to 3 absolutely crucial questions every trader must answer before putting any capital at risk.
Okay, what are they?
First, where and on what basis do I enter? This defines your trigger, your setup.
Got it. Entry.
Second, if the trade goes profitable, where do I exit? That's your profit target. You need to know when to take the win.
Profit exit. Makes sense.
And third, arguably the most important, if the trade goes against my analysis, where do I exit with a stop loss? That's your vital risk management, your escape hatch.
The stop loss. Crucial.
Absolutely. Simple questions on the surface, yet ignoring even one of them is, well, it's basically a recipe for disaster.
Okay, and here's where it gets, for me, really interesting. Jeffrey Kennedy, he's a prominent market analyst.
Yes, very well respected.
He breaks down a successful trading system into 3 components, and their relative importance is genuinely astonishing. It kind of blew my mind.
Go on.
Your strategy, often called technical analysis, the where to buy or sell, that only accounts for about 10% of your success, just 10.
Only 10% for the actual where. That surprises a lot of people.
Right. Then money management, which is all about how much to trade, your position sizing, that's maybe 30% important, still significant.
30%,
Yeah.
okay.
But the overwhelming majority, a whopping 60%, is psychology, controlling your fear, your greed, all those other powerful emotions that swirl around when money's on the line.
60%. That's the lion's share, by far.
It really is.
And the striking disconnect here, this is what truly costs most traders. The 95% who struggle, they spend virtually like 100% of their energy obsessing over the strategy part.
The 10% part.
Exactly, that tiny 10% piece of the puzzle. And in doing so, they tragically neglect the critical 60% that is psychology, and often a significant chunk of that 30% money management too.
Wow, so this raises a really important question. What does such a profound imbalance actually cost them in the long run? I mean, besides money.
Oh, it costs time, energy, confidence. It leads to burnout. It's a huge drain.
So if psychology is that dominant, what does this actually mean for building an effective strategy, one that can actually handle the mental game?
Well, it means your strategy needs rules, clear rules, but then once you've got those rules defined, you absolutely have to test them rigorously.
And that means?
That means back testing using historical past data to simulate how your strategy would have performed.
Okay.
And then, crucially, moving on to forward testing, which means testing it in live market conditions, but maybe not with your full capital yet.
Got it. Back testing first. What's the main goal there? It's not predicting the future, right?
Definitely not predicting the future. Think of back testing more like building a reliable roadmap based on past journeys. It's how you gain a sense of control and develop realistic expectations.
Okay, like what?
For instance, if your strategy historically has an 80% win rate, backtesting helps you understand and prepare for what to expect during that unavoidable 20% loss period. How long might those losing streaks last? How deep might the drawdown be?
So it prepares you mentally for the inevitable losses.
Precisely. And it's also where you can truly refine your money management rules before any real money is actually on the line.
Okay, that makes sense. And this leads us to a really critical concept. Robustness. How do you make sure your strategy isn't just like a paper tiger, good on historical data, but falls apart live?
Yeah, that's the million-dollar question, isn't it? It
Yeah.
really comes down to distinguishing between in-sample data, that's the data you used to build, and maybe optimize the strategy.
Training data.
Right. And out-of-sample data, which is completely new, unseen data that the strategy hasn't encountered before. A truly robust strategy performs reasonably well on both.
Okay.
Our sources offer a great analogy here. It's like crash testing a Volvo. You care much more about how it performs in messy, real-world collisions, not just in some perfect controlled lab environment.
Love that analogy. Real world matters most.
Exactly. And this also highlights the danger of what's called over-optimization or curve fitting, trying to force a strategy to look perfect on past data.
How does that happen?
Well, for example, a trader might find a 200-day moving average strategy doesn't look great historically, so they tweak it. Maybe a 217-day moving average looks perfect on that specific past data set.
Fitting the curve exactly.
Right. But as Mark Douglas, the author of Trading in the Zone, points out so brilliantly, each moment in the market is unique. Trying to perfectly fit a historical outcome onto a dynamic, ever-changing present. That's usually a recipe for frustration and ultimately failure.
Okay, so avoid over-optimization. Which brings us then to forward testing. That absolutely crucial bridge after you've refined your strategy through back testing.
Yes. And this is where many new traders fall into a trap. They rely solely on paper trading or demo trading.
Why is that a trap? Isn't it good practice?
It offers a safe space to learn the platform, the mechanics, yes. But it's insufficient because it entirely lacks the real emotional impact of risking actual money. There's no fear, no greed when it's fake money.
Right, no skin in the game.
Exactly. Our sources strongly recommend starting forward testing with a tiny amount of real capital, say just $50 from a $10,000 trading account, or maybe 0.5% of your total funds, just enough to feel something.
Just enough to make it real emotionally.
Precisely, to truly experience that psychological reality.
So, why is this step non-negotiable? What does forward testing uncover that back testing can't?
Oh, it uncovers a host of hidden weaknesses. First, it exposes if your strategy really is over-optimized. Does it work live like it did on paper?
Okay.
It reveals if your strategy rules aren't as clear and objective as you thought when you're under pressure.
Ambiguity creeps in.
Yes. It can highlight practical issues too, like low liquidity. Maybe it's hard to actually enter or exit trades at your desired price in real time, especially in smaller markets. Backtesting won't show you that.
Good point.
It even shows whether you, the trader, are consistently present and disciplined enough to execute when the signals actually fire. Are you available? Are you
Your
focused?
own reliability.
Exactly. And perhaps most importantly, it shines a harsh light on poor execution skills, like that lag between seeing the signal and actually placing the buy or sell order when things are moving fast and emotions are high.
Okay, so back testing, then forward testing with small, real money. Absolutely crucial steps.
Non-negotiable.
So once you've done all this groundwork, built the strategy, tested it, how do you really know if it's performing well? Beyond just a gut feeling like, I think it's working.
That's where you need to speak, let's call it the language of conversation with your strategy. You need objective measures.
Okay. What do you mean by that?
Think of it like this. Knowing someone's exact height and weight in numbers tells you far more, objectively, than just describing them as tall or thin. Numbers provide clarity.
Got it. So this is where key performance indicators, or KPIs, come in.
Exactly. These metrics provide incredible clarity and objectivity about your strategy's actual performance.
What are the key ones we should track?
Okay, first, there is your win rate. Simple enough, the percentage of your trades that end up profitable.
Win rate.
Conversely, your loss rate is the percentage of losing trades. Those two should add up to 100%, obviously.
Win rate, loss rate. Check.
Then, a really important one, the payoff ratio. This is calculated by dividing your average win amount by your average loss amount across all trades.
Average win divided by average loss. What does that tell you?
It tells you the average profitability of your winning trades compared to your losing trades across the entire strategy's history. This is different from risk to reward, which you might set for an individual trade before entering. Payoff ratio looks at the actual results over many trades.
Ah, okay. Strategy level profitability versus trade level potential. Got it.
Precisely. Then you also have your profit factor.
Yeah.
This is simply your total gross profit divided by your total gross loss.
Gross profit over gross loss.
Right. Any value above 1 indicates overall a profitable strategy. The higher, the better, generally.
Makes sense. Profit factor above 1. And
Finally, expectancy. This is a truly powerful concept, actually pioneered by mathematicians like Pascal and Laplace in probability theory.
okay, expectancy. How's that calculated?
The formula is win rate times average win minus loss rate times average loss.
Okay. What does that number actually represent?
It reveals the average profit or loss you can expect per trade over the long run, based on your strategy's historical performance. A positive expectancy means you should make money over time. Negative means you'll lose.
Wow, that sounds incredibly useful, knowing your average profit or loss per trade.
It is. And a striking point revealed by these metrics, especially expectancy and payoff ratio, is that a high win rate alone doesn't guarantee success at all.
Really? That seems counterintuitive.
It does, but think about it. Our sources highlight the minimum win rate formula needed for break-even, which basically depends on your risk-to-reward ratio. We can put the formula in the show notes.
Okay.
But what it shows is that a strategy can actually be profitable even with a low win rate, say, only 40% wins, if the average size of those wins is significantly larger than the average size of the losses. Your risk-to-reward needs to be high enough.
So winning big and losing small, even if you lose more often.
Exactly. It's all interconnected. Ultimately, these metrics are absolutely essential for accurately evaluating your strategy, for comparing different strategies objectively, and for truly understanding the why behind your trading results, good or bad.
Okay, metrics are key. Now, this next section feels like it's all about survival. Warren Buffett famously shared his golden rule for the markets.
Ah, yes, the Buffett rules.
Never test the depth of the river with both feet. He actually has 2 rules, right? Rule number 1, preserve capital.
Preserve capital.
Rule number 2, never forget rule number 1.
Never forget rule number 1. Sounds incredibly simple, almost cliche.
It does. But as you'll see, and as our sources confirm, it's often the hardest rule to actually follow in practice.
It really is. And this is where understanding the asymmetry of loss becomes absolutely crucial. It's genuinely eye-opening for many traders when they first grasp it.
Asymmetry of loss. Explain that.
Okay, consider this. If you lose, say, 2% of your capital, you only need about a 2.04% gain on the remaining capital to get back to where you started. Manageable, right?
Yeah, seems okay.
But if you lose 50% of your capital,
Yeah.
half of it gone,
Yep.
You now need a 100% gain on what's left just to get back to even. You have to double your remaining money.
Wow. Double it just to break even.
And it gets worse. If you suffer a devastating 80% loss, you're left with only 20% of your original capital.
Right.
That demands a massive 400% gain just to recover your starting capital. You need to multiply what's left by 5 times.
Good grief. That's almost impossible for most.
It becomes exponentially harder. The exact recovery formula for those interested will be in our show notes. But the profound takeaway is simple. Large losses are incredibly difficult to recover from. This makes capital preservation your absolute paramount priority. Rule number 1.
Never forget rule number 1.
Okay.
And nothing seems to magnify that asymmetry quite like leverage, which you hear about all the time. It really feels like a double-edged sword.
It absolutely is the definition of a double-edged sword in trading.
It allows you to trade with far more capital than you actually possess, right? Like, I see things like 1.100, 1.125 leverage on platforms like Binance.
Exactly. So 1.125 leverage means for every $1 of your own capital you put in, you're controlling $125 worth of the asset.
Sounds amazing for profits.
It does. And while leverage undeniably magnifies your potential profits, the crucial point is it magnifies your potential losses to the exact same degree.
Ah, there's the other edge of the sword.
Precisely. This is why leverage can lead to incredibly rapid liquidation, where your position is automatically closed by the broker because your losses exceed your margin or even complete account destruction. Bang, it's gone.
And the brokers. They seem to love offering it.
Well, of course they do. It directly increases the trading volume, the size of the positions being traded, and by extension, it increases their commissions and fees. It's in their interest.
Right. Okay, so given this immense risk, especially with leverage, how do you practically manage it? How do you protect that capital?
It all comes down to disciplined position sizing, calculating precisely how much of an asset to trade for each individual position you take. Not guessing, calculating.
Okay, position sizing. How does that work?
The core idea here is defining your risk per trade. This is the maximum percentage of your total trading capital that you are willing to lose on any single trade.
A percentage of your total account.
Yes. Typically, professionals recommend a low percentage, like maybe 1% or 2%, sometimes up to 5% for very aggressive strategies, but rarely more. Let's say you choose 2%.
Okay, 2% max loss per trade.
Then you use a specific calculation, again, we'll put the formula in the notes, that takes your risk per trade percentage, your account balance, and the distance between your entry price and your stop loss price for that specific trade.
Right, the stop loss distance.
And it tells you exactly how many shares or contracts or units of that asset you should trade.
Ah, so the position size adjusts based on the stop loss distance?
Exactly.
Sure.
The beauty of this is that it ensures you only risk your predefined amount, that 2% in our example, regardless of whether your stop loss is tight or wide for that particular setup. It gives you immense control over your risk on every single trade.
That's powerful. Consistent risk, regardless of the trade setup.
Very powerful.
And speaking of control and knowing what to expect, understanding your strategy's historical drawdown and consecutive losses seems vital too.
Absolutely vital. Drawdown is simply the measure of the peak to trough decline in your account value during a specific period. The biggest dip.
Okay.
Knowing your historical maximum drawdown and also your historical maximum number of consecutive losing trades from your backtesting. It isn't just about crunching numbers.
What is it about then?
It's absolutely crucial for emotional preparation. So when that inevitable string of losses hits, and it will hit eventually, even with a great strategy, you know it's within the bounds of what to expect. You don't panic.
Because you've seen it before in the data.
Exactly. You know it's normal for your system.
Okay. This brings us to another concept, risk of ruin, or RRR. Sounds ominous.
It is pretty serious. RRR is the statistical probability of losing all your trading capital, or at least reaching a point where you can no longer effectively trade your strategy, blowing up your account.
The probability of total failure, how do you even calculate that?
It's complex, involving your win rate, payoff ratio, and crucially, your risk per trade percentage. But think of a casino analogy, like French roulette.
Okay.
The house only has a very slight edge. That single green zero gives them about a 2.7% advantage over the player on even money bets. Tiny edge.
Right. Small.
But that small, consistent edge ensures that over thousands and thousands of spins, the casino always wins. Statistics are on their side.
Right. The law of large numbers.
Exactly. Traders face a similar statistical challenge, but often stacked against them if they're not careful. Even a fundamentally decent strategy, let's say with a 55% win rate and a 1.1 payoff ratio.
Better than 50-50.
Yes. But it can still have a surprisingly high risk of ruin, maybe 13% or more if the risk per trade is too high, like 5% or 10% of capital per trade.
So even a winning strategy can blow you up if you bet too big each time.
Absolutely. The goal, through proper position sizing and risk management, is to get your calculated risk of ruin down to zero, or as close to zero as practically possible.
Makes sense. Survival first. Okay, so to sum up this whole money management piece, our sources seem to emphasize 5 key recommendations. What are they?
Okay, first, don't miss opportunities. This sounds counterintuitive after talking about risk, but if your tested strategy and your risk parameters allow for a certain level of risk, like that calculated position size, don't be too conservative out of fear and leave potential profit on the table consistently. Follow the plan.
Okay, follow the system. Don't be overly fearful.
Second, don't over-risk.
Mm-hmm.
The flip side, never ever risk more than your predefined amount per trade. Chasing losses or getting greedy by sizing up randomly almost always leads to greater long-term losses. Stick to the calculated size.
Got it. Discipline on both sides.
Third, especially for beginners, capital preservation is priority 1. Focus on protecting your capital first. Maybe start by risking only 1% per trade instead of 2% or 3%, even if your backtest allows more, until you've proven you can achieve consistent profitability over time. Survive first, then thrive.
Survive first. Good advice. 4th recommendation.
Fourth, define your trading period. Evaluate your performance over a set period, like weekly or monthly, rather than getting emotionally caught up in the outcome of every single individual trade. And adjust your risk calculation, the account balance part of the position size formula, based on your account balance at the start of that period, not constantly changing it mid-period.
Okay, evaluate periodically. Adjust risk based on starting balance for that period. And finally, number 5.
Finally, and this is crucial, be ready to exit. Not just a single trade, but the strategy itself if needed. If your live strategy's performance significantly deviates from your back-tested results, for example, if you suddenly experience way more consecutive losses than your backtesting ever showed was likely.
If something seems broken.
Yes. Stop trading immediately. Don't just keep going hoping it will fix itself.
Sure.
Step back, reevaluate the strategy, figure out what's changed or what went wrong. The market isn't going anywhere. Don't force a system that's clearly not working anymore.
Stop. Reevaluate. Don't force it. That's huge. Okay. So, after all that, robust strategies, meticulous numbers, careful money management. Why do so many smart, disciplined people with seemingly good plans, still end up failing?
Now we get to the core of it.
This, as we highlighted right at the start, is the 60% psychology piece. It's massive.
It really is.
Yeah.
As Benjamin Graham, who's often called the father of value investing, famously stated, the investor's chief problem, and even his worst enemy, is likely to be himself.
Himself. Wow.
Profoundly true in trading. To simplify how our brain actually works, especially under the pressure of trading, let's look at Paul MacLean's triune brain theory. It's a model, but useful.
Okay, triune brain, 3 parts.
Essentially, yes. Think of 3 layers.
Yeah.
First, the reptilian brain. This is the oldest, most primitive part, located at the brainstem. It's focused purely on instinct and survival, fight or flight.
Primal stuff.
Very primal. It's fast, automatic, operates largely unconsciously, like pulling your hand away from a hot stove before you even think about it. It also handles ingrained habits, like driving a familiar route almost automatically.
Okay, the reptilian brain. What's next?
Then, layered on top or inside, you have the limbic brain, or the mammalian brain. This is our emotional control center. It's responsible for feelings, fear, joy, anger, attachment.
The emotional brain.
Right. And when it gets highly active, especially under stress like a losing trade, it can make us incredibly, well, unreasonable. It can lead to those impulsive decisions and that deep regret later when we completely ignore our own logical trading rules because we felt something strongly.
Yeah, I think we can all relate to that feeling of regret after an emotional decision.
Absolutely. And finally, the outermost layer, the largest and newest part of the brain evolutionarily, is the neocortex.
The thinking brain.
Exactly. This is where complex thought, logic, reasoning, language, and planning happen. This is the part of your brain that meticulously designs your trading strategy, where you analyze charts, plan your entries, your exits, your risk management. It's your rational decision maker.
Okay, reptilian, limbic, neocortex. Instinct, emotion, logic.
That's a good summary.
And this maps almost perfectly onto Daniel Kahneman's System 1 and System 2 thinking from his book, Thinking Fast and Slow, doesn't it?
It really does. System 1 thinking aligns beautifully with our reptilian and limbic brains. It's fast, automatic, intuitive, and deeply emotional. It runs the show most of the time without us even realizing it.
The autopilot.
Pretty much. And here's where the pain versus pleasure principle, which Kahneman also researched extensively, becomes your absolute enemy in trading. The psychological pain of experiencing a loss is felt about 2.5 times more strongly than the pleasure of an equivalent game.
2.5 times stronger pain from loss versus pleasure from gain.
Roughly, yes. And this fundamental imbalance is a major reason why traders often cut winning trades short. They're terrified of losing those unrealized paper profits, wanting to lock in the pleasure quickly.
Okay.
But then they let losing trades run and run, sometimes into disaster, simply because the act of realizing the loss, of making it real by closing the trade, is so psychologically painful, they avoid the pain.
Wow, that explains so much irrational behavior right
Yeah,
there.
it really does. And then, of course, there's system two, which aligns with our neocortex. It's slow, logical, requires conscious effort and attention. This is the part that should be in control of your trading decisions, the part that follows the plan.
So the battle is getting System 2, the neocortex, to override System 1, the emotional limbic reptilian response, when trading.
That's the essence of trading psychology. And the solution lies in developing your emotional intelligence, or EQ. The good news is EQ is a highly adaptable skill, not some fixed trait you're born with. You can improve it.
Okay, EQ. How does that help?
Well, Daniel Goleman's seminal book, Emotional Intelligence, outlines 5 crucial components. For trading, the first 3 are perhaps the most vital.
What are they?
First, self-awareness. Truly knowing your own emotions as they happen. Understanding what triggers them in a trading context. What makes you fearful? What makes you greedy?
Knowing yourself.
Yes. Our sources suggest thinking about concepts like the Johari window, particularly the blind spot things others see in you that you don't see in yourself. This is why having a mentor or a trading coach can be so incredibly valuable. They help you uncover those emotional blind spots.
Okay, self-awareness. Second component.
Self-regulation. This is about managing your impulses and emotional responses. It's about controlling that urge to slam your keyboard or immediately place a revenge trade right after the market moves against you. It's about pausing, breathing, and letting the emotion pass before acting.
Managing the reaction. Got it. And third,
Self-motivation. This is deeply tied to brain chemistry, particularly dopamine, the reward chemical. It's what fuels persistence, the drive to stick to your plan even during drawdowns, and keeps you focused on your long-term trading goals rather than chasing instant gratification.
okay, awareness, regulation, motivation. Key EQ skills for traders.
Absolutely fundamental.
Now, let's zero in on the specific key destructive emotions in trading. The ones that so often hijack that logical neocortex and sabotage even the best laid plans and strategies. First up, gotta be fear.
Fear is huge, and it's complex, and it manifests in several insidious ways in trading.
Like what?
Well, there's the fear of losing previous gains you've already made on paper. This makes you cut winning trades way too short, leaving significant profit on the table because you just wanted to lock something in.
Taking profits too early out of fear.
Right. Or there's the simple primal fear of losing money, period. This can lead to paralysis, causing you to hesitate and miss perfectly valid trade setups according to your plan. Analysis paralysis driven by fear.
Okay, what else?
Then there's the infamous fear of missing out, or FOMO. That nagging feeling that everyone else is making money on a big move and you're not.
Ah, FOMO. See that mentioned everywhere.
It pushes you to jump into trades impulsively, without proper analysis, often right at the peak of a move, the absolute worst possible moment, chasing price.
Buying the top. Okay, any other fears?
One more subtle one. The fear of not gaining enough. This sounds odd, but it can lead you to hold on to winning trades for too long, hoping for just a little bit more, letting them actually reverse and turn into losers. Greed disguised as ambition, perhaps, fueled by a fear of leaving money on the table.
Wow, fear is multifaceted. So what's the solution? How do you manage it?
The key is to acknowledge the fear. Don't pretend it doesn't exist, but then manage it by consciously defaulting back to your logical, tested strategy and rules. Accept that losses are an unavoidable part of the probability game of trading. You will have losses. Trust the plan over the feeling. Be patient, like the tortoise in that famous fable, waiting patiently for the high probability setup, not chasing like the hare.
Trust the system, accept the losses, be patient. Okay, next destructive emotion.
Greed. The flip side of fear, perhaps. This is simply the desire for more than logic dictates, more than your plan allows.
Finding too much, too fast.
Exactly. It's a powerful force.
Yeah.
It often leads to over-leveraging, using way too much leverage because you want massive profits now. Or it leads to dangerous martingale-like behavior, where you actually add to losing positions, doubling down, convinced it has to turn around.
Averaging down into a loser, bad idea.
Usually a terrible idea, driven by greed and hope. It's often fueled by unrealistic expectations, wanting to buy that dream car or house way too quickly, instead of focusing on consistent profitability and letting compound interest work its magic steadily over time.
So the solution to greed.
Discipline again. Religiously stick to your predefined profit targets from your strategy. Have a plan for taking profits and follow it. Don't let a winning trade turn into a loser simply because greed pushed you to hold on too long, hoping for the moonshot.
Stick to the plan for exits too. Okay, what's next? Fear, greed.
Anger. This is an incredibly destructive emotion in trading, maybe the most destructive. It causes both physical symptoms. You might feel your face get hot, your mouth go dry, muscles tense up,
Yeah, the physical sign.
and significant psychological harm. Anger directly leads to what's called revenge trading.
Revenge trading.
Yeah, after taking a loss, you feel angry at the market, you feel cheated, and you immediately jump back in, often trading larger without any strategy, just making impulsive decisions to get your money back from the market. It almost never ends well. Sometimes people literally break monitors or keyboards.
Wow. Okay. Solution for anger?
First, recognize those physiological symptoms. When you feel them, that's your alarm bell. Step away immediately. Walk away from the screen, even if it's just for 10 minutes, maybe longer, maybe the rest of the day. Calm down completely. Then, try to address the root cause constructively later. Why did that loss make you so angry? Was your risk too high? Was the trade outside your plan? Never trade while angry.
Just step away, calm down, analyze later. Got it. What other emotions trip us up?
Another significant one is bias or prejudice, which falls under the umbrella of cognitive biases. This is essentially being fixated on your initial analysis or your trade idea, refusing to accept clear evidence that the market has moved against you and your idea is wrong.
Stubbornness, basically.
Exactly. The endowment effect, another cognitive bias, plays a powerful role here too. We tend to overvalue things we already possess, including a trading position. This makes it harder to let go of a losing trade because it's yours. You hold on based purely on irrational hope that it will come back, ignoring the objective signals.
Hope is not a strategy.
Definitely not. The solution is cultivate acceptance. Accept that the market doesn't know you exist, it doesn't care about your desires, your predictions, or how much research you did. It moves based on the aggregate actions of millions of participants. You must strive to be neutral and objective, following your signals, not your hopes or biases.
Be neutral, follow the signals. Okay.
One more. Let's talk about impatience. This is the failure to wait for valid setups that meet all the conditions of your predefined strategy. Just jumping into trades prematurely because you're bored or feel like you should be trading?
Feeling the need to always be busy.
Right. But remember that 80-20 rule we sometimes hear in trading. The idea that maybe 80% of your profits will come from only 20% of your trades.
Yeah.
Whether the numbers are exact or not, the principle holds. Successful trading inherently involves a lot of waiting. Waiting for the right conditions, the high probability setups.
So the solution is simply patience.
Patience is absolutely crucial. You have to wait for your well-defined setup to occur according to your plan. Think of it like a traffic light for your trading. Green means all conditions met, go ahead, execute the trade. Red means conditions are absolutely not met, stop, do nothing. But yellow means wait, conditions are developing, be cautious, watch closely. And honestly, a lot of time in trading is spent waiting patiently on that yellow light.
Wait for the green light, don't jump the yellow or run the red. Love that analogy.
What helps frame it mentally.
Okay, wow. We've covered a lot today. We've navigated this surprisingly complex landscape of trading, haven't we? From those stark statistics of failure right at the beginning.
Yeah, 93% and 5%.
All the way through strategy, money management, and deep into the intricate depths of human psychology, it's become abundantly clear that sustainable trading success isn't just about picking the right chart pattern or finding some magic indicator.
Not at all, indeed. We've seen how absolutely crucial a robust, tested strategy is. That's your foundation. We've seen how meticulous money management acts as your first and maybe most important line of defense for survival.
Rule number one.
Rule number one. And we've seen how a deep, ongoing understanding and management of your own emotional and psychological wiring, that 60% piece, is truly the ultimate differentiator between success and failure.
Yeah.
It's really about being prepared for what the market is, objectively, not what you want it to be or hope it will be. The market, after all, as they say, is always right.
The market is always right. And if that's true, and if your biggest obstacle to consistent profitability is often, as Benjamin Graham said, staring back at you in the mirror, what does it truly mean then for you listening to take full, radical responsibility for your entire trading journey, every decision, every outcome?
That's the question to ponder. We sincerely hope this deep dive today has given you some powerful new insights, maybe some actionable tools to reflect on your own approach, not just to trading maybe, but to knowledge, skill development, and mastery in any complex field you pursue.
Until next time.
Keep learning, keep growing, and keep diving deep.